All right, so a question that I get asked quite often is whether or not I actually save money in the current market environment where we're seeing very low interest rates right now, or if I invest the majority of my money and take it out of savings so that it's invested in the market. And then from there, well, what are some options available to new home buyers or individuals who are looking to save up to a down payment? All right, so should I be saving up towards that down payment exclusively, or on the other hand, have that money invested in the market to try and expedite the process of building up enough cash for that down payment or any other large purchase for that matter? Hey, how's it going, everyone? My name's Griffin, and as a real estate investor and having just purchased my first home in the past year here, well, obviously it's come to my attention that home prices across Canada and the United States have pretty much skyrocketed and jumped aboard a flight with Jeff on a Blue Origin rocket. In fact, while home prices tend to appreciate by an average of around 3 to 5% per year, well, average Canadian home prices have jumped up by 38% since last year, and the same holds true in the United States, with average home prices having climbed by roughly 13.2% on average nationally, with some markets like Austin, Phoenix, and Salt Lake City having appreciated by multiple double-digit growth figures. Now, of course, this probably is not new information to anyone watching this, but the real issue lies in the fact that for many younger individuals and millennials specifically, the aspiration of becoming a homeowner is somewhat more far-fetched than ever. And also it's quite confusing as to what really should I be doing in order to save up to a down payment. The reality is that interest rates are likely to continue remaining low for years to come. We're faced with significant levels of inflation in the short term, and then housing prices also remain very high. So saving cash is extremely difficult to accomplish in the current market environment. All right, so right off the bat, a question I get asked every single week is whether or not you should be looking to time the housing market in order to make your first purchase. And my short answer to that is no, you probably should not. Now, of course, with housing prices having risen so dramatically over the past year, though, one could assume that, well, we're probably at the top of the market and we might actually end up seeing some form of correction in the mid to near future, which is definitely a fair assumption. In fact, even though prices do remain well above what they were at this time last year, we are actually seeing property values cooling off a bit for the second month in a row as of June, indicating that things are stabilizing a bit since the peak of March 2020, right? So if we take a look at this chart right here, overall in Canada, housing prices are down roughly 5.6% since March of this year, with differing figures depending on the province, but whether or not this will continue to fall, ultimately no one really knows. And that's why trying to time the market, whether or not it's the housing market, the equity market, crypto market, whatever type of market you're trying to time, typically this is not the best course of action. Circumstances have changed over the past 2 years since I first started investing in property, but put it this way, 2 years ago, I do remember actually thinking to myself, well, based on all the news articles and headlines I'm seeing right now, I should probably wait to actually see a correction and I'll try to time the market before getting in. Of course, this is not what ended up happening. The market appreciated by 30-40% since I first had that thought. And luckily, I did not wait to purchase my first property. So I'm really just of the mindset that patience and really just narrowing down your selection criteria and then focusing on trying to find a property that fits within that criteria and also fits within your financial means is most likely going to be the best option. The reality is that most properties will continue to appreciate over the next 10 years or so. And if you have a long enough holding period, even if over the last year or two, property prices have appreciated by more than the annual average. So unless you're looking to buy a multi-million-dollar property with a much smaller pool of buyers, most likely, even if you're buying a house or other property right now in an inflated market over a 10-year hold, it's still going to appreciate in value. And during that period of time, you're paying down the loan. So most of the time, this is still going to be a good decision. And if you're able to narrow down your search criteria, there are still deals to be had regardless of the market. All right, so I kind of went off on a tangent there, but from here, these are a couple other elements that I would want you to keep in mind and consider. First of all, you need to think of your opportunity cost in this larger rationale behind your home buying process. If you still live at your parents', for example, and you don't pay a dime in rent and other costs associated with housing, then of course, purchasing a house right now that might be a bit higher in value might not be the best option. If you're currently in a situation where you're renting though, and say your monthly rent is around $1,600 per month, well, that's over $19,000 in a year that you're never going to be seeing again. 10%. Whereas in contrast to this, even if you purchase a house that's say $400,000 in value right now, well, in this first year of ownership, you're going to build more than $10,000 of equity in that property. The next thing I would say is just don't buy a property that's super expensive, above your means, and that's flush with market value, because that's really where, in the event of a market downturn where the value of the house would depreciate, well, that is where you're in a situation of negative equity. If you buy a house like what I did right here, where in this neighborhood right now a renovated house is going for above $550, I got it for $320,000. Now, yes, there was a bunch of sweat equity that went into this property, but now, regardless of what happens in the market, even if, well, I don't plan on selling, but even if it declines in market value from that $550, I'm still in a position of positive equity. I speak about this quite often in regards to rental property investing, which is the BRRR strategy, where basically you buy a place under market value, do some renovations, and then rent it higher, and it's worth a lot more. So you can refinance it, take out some equity, and repeat the process. But the same can also somewhat apply to a principal residence. You don't have to buy a rental property to do this same strategy. For example, you can buy a house under market value, put in $50,000, and then it's worth significantly more than what you paid for it and put into the property. And this is an easy way that basically anyone can level up their own property, do some forced appreciation, and then also increase their net worth significantly while also paying down the debt, which is their mortgage, and not having to just give money out of your pocket to a landlord every month, buying them assets. I'm not sure where we're at here, probably the third element to consider, but another thing that you need to keep in mind is that depending on how much you put down for your down payment, this is going to impact your monthly payments. And I'm not going to get into this too much, but basically the more you put down on the property, the lower your monthly payments will be because your balance is much smaller. However, saving up to a much larger down payment, say 20-30%, could take years potentially, right? On a $400,000 house, for example, a 20% down payment is $80,000. So what's the difference between saving up to $80,000 or what would it be, $20,000 for 5% down? That could potentially be years of difference. So yeah, definitely something to keep in mind here. And I personally usually recommend putting as little down as possible, because you're able to put less money and capital tied up into that property to then have more capital available to you to invest in other actual investment opportunities. You'd then be taking advantage of debt pay down, appreciation of the property, and also potentially forced equity, all of which is going to significantly increase your net worth. But that's really just my opinion on the matter. I believe 5% down for a first-time home buyer is most likely going to be the best option. Now, of course, I realize that purchasing a home can be quite overwhelming, and so that's why it's really important that you understand each step of the process along the way. And I actually outlined all of this in a full 30-minute video going over the 12 steps necessary to purchasing your first home or rental property. So I'm going to put it right here. I would highly recommend that you check that video out. It is pure gold in my opinion. Okay, so I'm kind of blabbering on about different things to consider before purchasing a property or other large purchase, but the reason why we're really here is we want to know what are some actual real concrete options available to us right now to save up to that down payment. So in reality, there are really only a few options available to us. You can either sock away physical cash in a mattress, definitely not the right option. Otherwise, you can tie up your money in a CD, for example, for 1, 2, 3, 5 years, and you'll make a fixed interest on the money that's tied up. Otherwise, you can have a high interest savings account, which right now isn't all too high interest. We'll be diving into both of these shortly though. And then also you can just invest in the stock market through either individual stocks or through exchange trade funds. So before we dive into all three of these though, let's just preface this with speaking about the devaluation of the dollar and losing out on purchasing power as a result of the amount of money that's been printed over the past year, both in Canada and the United States. So this right here is a chart of the 12-month change in the CPI, which is the Consumer Price Index, essentially the inflation that we've been seeing over the past couple of years. So at the beginning of the pandemic, well, we saw that inflation was an average 2.4%, which is somewhat average yearly annual inflation. Now, in the peak of March, or right after March, actually in May, we actually saw deflation at -0.4. And now right now we're extremely high at at 3.1. So basically what this means is that every dollar that you have in your bank account is essentially losing 3% in value per year at the present moment. And the same holds true for the consumer price index over in the United States. This right here is a chart showcasing the inflation levels right now, which are actually higher than in the Canadian economy. So depending on the strategy that you want to deploy for your saving and investing, we always need to keep in mind that inflation is going to play a large role in your real return on investment for a year. So with everything that we speak about on this channel about investing, you always need to keep in mind inflation for calculating your total real return. All right, so let's get back to the options available to us for saving up some money, right? So with the really low interest rates right now, yes, mortgage rates are lower, but also your interest on things such as GICs as well as investment accounts are going to be, your savings accounts, I should say, are going to be lower. So right now, GICs in Canada, here are some examples. We can see that the highest one right now is 1.55%. So on a $5,000 investment, we'd be looking at $78 in total return based on that $5,000 investment. That is very low and not significant. And when you take into account the CPI, the inflation we just looked at around 3.1 right now, you'd actually be losing out on your investment for the year, right? You'd be in negative territory in terms of purchasing power of that $5,000. So of course, that's not necessarily something that I would utilize because we're looking at negative return. And that's also on a 1-year term where you're locking up your money for a year and you do not have access to it. If we take a look at some longer terms, let's say a 5-year GIC, the rates are a bit higher at 2.2%. You'd still be losing out on total return, but your cash is locked up for 5 years. And so if you're looking to purchase your house within 5 years, you're not actually going to be able to touch that money and utilize it for a down payment. The second option available to us would naturally be a high interest savings account, or HISA for short. Now, in the past, we've seen interest on these accounts at like 3-4%, which is phenomenal for pretty much doing absolutely nothing. And on the average year, this would slightly beat inflation. However, right now with higher CPI rates and then also low interest rates from these high interest savings account, right now we're looking at 1.25%, 1.55% on these HISAs, which again is not going to actually beat inflation on a total return standpoint, taking into account the current inflation rate. Some advantages, however, of a high interest savings account: this is obviously liquid, so it's not tied up for a certain period. You can withdraw and deposit money into these accounts pretty much whenever you want. Now, there might be some fees on deposits and withdrawals, but that's going to be dependent on the account in question. And another thing to keep in mind with high interest savings accounts is that the interest rate can actually change at any time and based on the discretion of the bank or credit union that you have your account with. So at the beginning of last year, for example, most of these accounts had interest rates of 2-3%, and they were slashed down in increments as the federal government was lowering the underlying baseline interest rate in order to try and stimulate the economy, stimulate borrowing further, and then also investments into asset classes like real estate. And now also that's resulted in higher investments in liquid assets or paper assets as well, like the equity markets. And then the third most common way to save up to a down payment would be investing in exchange traded funds, specifically core exchange traded funds. Things like, for example, a total US market fund, an S&P 500 fund, essentially a fund that's going to expose your investment to hundreds of companies and therefore have significantly less volatility. And also your capital can grow in accordance with the market. Now, of course, this does have a higher degree of risk than the two other options that we just looked at. However, there's also the capacity to make a higher return on investment. With that said, if we take a look, for example, at a chart of the S&P 500 here, we can see that over the past year, the S&P 500 has seen very nice growth in the multiple double-digit range, and the shorter time frame that we look at, the higher volatility. So that's really the main thing that I'm trying to get out of this video. It's going to entirely depend, or your strategy will entirely depend on your current situation and when you're looking to make your purchase or the purchase of your house, right? If you're looking to buy a house within 6 months, most likely you should not be investing that capital in the markets, because on such a short-term time frame is quite a bit more volatile and unpredictable. In contrast to if you're looking to buy a house in 5 years, well, most likely your investment in an S&P 500 ETF will severely outbeat over a 5-year period the rate that we just saw with a 2.2% fixed GIC. But to summarize what we just spoke about, essentially you have two options. Either you can invest in a GIC or a high interest savings account that does have a lower interest rate right now, but it's going to be quite a bit more conservative and you're not actually at the mercy of market movements and fluctuations. However, you are losing out on inflation each year if your cash is just sitting in an account like that. On the other hand, you can invest in the markets in equities like exchange traded funds and or even blue chip stocks, and you have the potential of creating a higher return. However, on a short-term time frame, it's more difficult to accurately predict how much you'll be gaining on your investment per year. And then also, in the event of a market decline, are you able to ride out that period of time for the markets to recover before you're actually looking to make that purchase? So that's why, of course, it's a case-by-case basis and will entirely depend on your financial situation and where you're at in life. But those are some things that you should be considering along the way. And that's why generally I recommend that if you're saving for a down payment within less than even a couple of years, honestly, you should probably be staying out of the markets if you have a very low tolerance for risk. And in parallel to everything we just spoke about, especially the strategy you're going to be deploying here, I really cannot stress enough the importance of trying to tailor and craft a strategy that suits your needs and your risk tolerance, right? Right now, I've been saving up over the past couple of months up to a year's worth of expenses in a savings account that's actually losing purchasing power every single day that I have that money in that account. However, for me, that is invaluable because I know that I have that security where if something goes wrong in the markets or with my primary income sources, well, I have up to a year's worth of expenses to cover that rainy day. All right, so that pretty much covers today's video. And again, everyone's situation is going to be different. So if you want more information or if you want to have maybe say a brainstorming session, this is something I've never spoken about on my channel, but you can check out, I made a link down below where you can actually book a call with me and we can chat about your situation. I really hope you enjoyed today's video. If you want to learn more about stock market investing, real estate investing, and just personal finance in general, make sure that you subscribe to the channel, hit the bell button to be notified of new and upcoming videos. And I'd also highly encourage you to check out all the other videos that I already have posted on my channel. So on that note, thanks a lot for watching today's video and I will see you in the next one.